Currently, the S&P 500 is down about 3.5%, the Nasdaq down 4.3%, and the Russell 2000 down about 4.5%. This is exactly what I was warning about here on the channel yesterday. I know some people were saying that I was just being too much of a downer. But hey, look at what happened today. It's exactly like what happened last Fed meeting, and this is pretty textbook. So let's talk about what markets are freaking out about today. And then I do want to go over AMC's cost to borrow rates are going higher. Not necessarily the cost to borrow max, but the cost to borrow minimum and the average cost to borrow max, or average cost to borrow, are going up, and that's something that I want to address here on this channel, potentially what that could mean heading into the future for AMC stock. We're going to dive into a bunch of other information here in this video. So without any further ado, hit that like button and subscribe to the channel if you guys find value out of the video. If you guys want to stay up to date with all of my trades in real time, we are on a winning streak like no other. Check that out. Come be a part of that program. Link down below in the pinned comment or in the description of this video. Let's dive into it. You guys already know free stocks, Webull, Movement in Public down below in the description as well. Get yourself that free money because it's not too often these days you guys can get yourself some free stuff, so take advantage of that. Now let's dive into exactly why the markets are freaking out today, and CNBC says it best right here. One of the main articles: a day after Powell's assurances about the economy, markets are worried that the Fed breaks something. Key points: Federal Reserve Chairman Jerome Powell insisted Wednesday that the central bank is not deliberately trying to cause a recession and that the economy is on solid footing. Quote, "With all due respect to that comment, it's just not consistent with the data on the ground," said RBC's economist Tom Porcelli, and basically saying that the Fed is wrong. That's not the data that we're getting. We're seeing layoffs. We're seeing bad GDP numbers. We're seeing high inflation. You're seeing the dollar, plummeting today, down 1%. You're seeing the yen continuing to weaken. You're not seeing a strong economy. There's no signs of a strong economy, and that's basically what I was trying to get across yesterday. Is even though the Fed is saying these things, there's still a big disconnect between the Fed's version of the economy and what is actually going on. At the same time, they're obviously going to have to raise rates during a recession, and that's something the markets will start to look forward to, and they will start to price that in, and that could consist of some more significant downside. You've hardly ever seen that in history where the Fed raises rates as you are in a recession. Continuing on with the key points of this article, it says the trouble is the Fed's likely to get a recession anyways, as data shows the economy is a far cry from stable. Consequently, markets whipsawed Thursday, going from a positive reaction on Wednesday to Powell's post-meeting comments to a rout as worries fester over what effects higher interest rates and tighter monetary policy will have on a fragile state of affairs. Quote, "What the markets is worried about even before you get to recession is a policy mistake that the Fed breaks something," said Quincy Crosby, chief equity strategist at LPL Financial. Quote, "The market also is questioning his comment that the economy is strong," end quote. More specifically, two comments that the Fed chair made stand out from the news conference. First, that the Fed is not trying to induce a recession. Now, let's be clear about that. Also, there's no sign of a broader slowdown that I can see in the economy. In fact, there are myriad signs of a slowdown, and that's the big problem. And then today as well, this did not help anything. It says on Thursday alone, real estate data for May showed a 14.4% monthly slowdown in housing starts at a time where there is a chronic shortage of homes. A Fed manufacturing reading showed continuing contracting in the Philadelphia region. Weekly jobless claims were higher than expected as well. So it's not lining up with essentially what the Fed said yesterday, and that's why the markets are selling down so much, and that's exactly what happened during the last Fed meeting. So we're getting a similar reaction. We went up 3% yesterday, almost on the SPY, and what happened today? Well, you've lost all of that gain plus some more downside, currently sitting around 365.70 on the S&P 500. So those are the things the markets are really concerned about. Let's go ahead and pull up the Fed rate monitor tool, and it looks like we are still only pricing in a half percentage rate hike at the next Fed meeting, so that is better than not. But we want to see where this rate continues to go to, and you want to watch the terminal rate to see where it starts to get priced, because we're falling today because of the economic comments. But if you guys remember, just yesterday, the day before that, I've been showing this July 26, 2023 Fed meeting, basically the projection of where the interest rates will be by then. And a vast majority of people expected the rate to be in between 4 and 4.25%. A vast majority, I think it was 37% of market individuals expected it to be in this range, and then about another 25 to 27% of market participants expected the rate to be in between 4.25% and 4.5%. Well, now a vast majority of market participants expect the rate to be in between 3.75% and 4%. So that is slightly less than what we were expecting before the Fed meeting. So that is a bullish thing. That is a good thing. The markets are expecting a little bit less rate hikes as of now comparatively to yesterday, but the economy is the real issue here. In a normal economy, if we had like what the Fed expected, 2.8% GDP growth in a year, we would be decently, okay with the Fed raising rates, reducing the balance sheet. But it's, growth slowing down. It's a recession at the same time as the Fed is doing that. That is going to cause a lot of panic, and then you don't know where to value companies. Like, you are getting the buys of your lifetime right now. To buy Square at $57, to buy SoFi at $5, DraftKings at $10. You're getting an opportunity to buy stocks at stupid low valuations because nobody knows where to value stocks, and for a lot of big money, they don't want to hold on to stocks right now. So in turn, what are they doing? They've already sold their stocks, but they continue to short stocks, and we can see that reflected in stocks like AMC. 22.9% estimated short interest of free float, 118.05 million shares are sold short, and this is the most notable thing for the day and what has really changed. Cost to borrow minimum is now at almost 15%. This thing was at 1% yesterday. So when I say the cost to borrow rates are climbing on AMC or going crazy, whatever the title of this video ends up being, it's that, the cost to borrow minimum of 15%. That is implying a move to the upside of roughly 15%. If you were to lend out your stock right now, what would be the interest rate you would want on your shares? Well, a vast majority of market participants want in between 15 and 25%, which 24.9% is the cost to borrow max. So it's telling you basically an implied move via what people are willing to lend out their stock for. So that is very bullish in my personal opinion. Very, very bullish. The short interest being so high, also, again, another bullish thing when you're thinking of the MOAS. Now, we do still have 100% share utilization. You have 195.04 million shares that are out on loan. So you do have about 80 million shares, 70 million shares, give or take, that can be used against us at some point into the future. So probably that's probably what is happening today. That's probably why the stock it says here on Ortex down about 9%. That would explain a lot. Now, the free float out on loan sitting at about 38%, meaning if all 195 million shares were actually sold short, then the short interest could potentially go as high as 38%. So keep that in mind. It looks like they've been collecting these shares and waiting for a downside move really to short them. But in the grand scope of things, AMC stock is still little changed over the last month or two. It's been really just up and down, but we have not done all too much at all. You want to watch for that bullish move coming here. Typically, that's what we've seen over the past week. We can extend down to about $11, but we end up closing usually around $11.50. We're currently sitting right at $11.50, so I think $11.50 is going to be a very important level that I personally want to watch. If we break under $11.50 and get more continued downside coming tomorrow, then it's possible you could head down to about $10 per share, but I think that's going to be a really, really strong level of support. If we do get that market bounce tomorrow, which is very possible, then you want to watch that $13 level. That looks to be this median ground that we kind of try to stay around, give or take 50 cents or so. And then you want to watch these moving averages. I say it every video, but they're so important. The 100-day moving average, 50-day moving average, and then inevitably the 200-day moving average once we break out above those. As far as the RSI, extremely oversold at 43.10, and the MACD is pretty neutral, slightly bullish still, which is just wild to me, even after a 10% drop. So looking pretty good as far as the MACD. It could be a lot more bearish right now, but the volume has been low for AMC stock, so it's really a time game waiting for volume to come back in. Volume is the key to stocks moving up, and essentially when that volume comes in, that's when AMC stock should move up in a big way. And as far as the Stocko tracker data, you're looking at 404,000 calls that are currently out of the money heading into tomorrow. If you do see a bullish reaction, it could be a very green day, just because on the day to essentially expiration on a Friday, if you start to get a stock like AMC with a lot of option activity, a lot of calls, and a lot of puts, once you break out at key levels 13, 15, if we get to those prices tomorrow, that's where you could see a lot of buying pressure, because the contracts expire the same day. When they go in the money, they have to be instantly hedged for. So that's a lot of potential buying power. I'm not a fortune teller. I'm not going to make a one-day short-term call, but you do have 404,000 calls that are out the money. So I will say that. In the money puts at 132,000. The max pain is still sitting at about $16 per share by tomorrow, so we will see what happens with that. Let's take a look at the option activity, then let's wrap up this video. So for the day, 7 orders totaling $231.16 thousand, positive order value of 71%. So the option activity does look bullish. Overall market not bullish at all, and this is the digestion from the Fed, simply put. So that is going to be all for this video. That's what you guys need to know in a nutshell. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and I will see you in the next one.